Tuesday cut its global economic growth forecast for 2018 and 2019, saying that U.S. China trade war was taking a toll and emerging markets are struggling with tighter liquidity and capital outflows. The new forecast, released on the Indonesian resort island of Bali, where the IMF and World Bank annual meetings are underway, show that a burst of strong growth, fueled partly by U.S. tax cuts and rising demand for imports, was starting to wane. Lagarde is IMF's managing director.
We need to make sure that there is level playing field, that there is proper competition and not unfair competition between players. Everybody needs to look at those issues, but it needs to be done together. That's really what we will continue to argue as a case for more international trade, more openness, and more benefits.
The downgrade reflects a combination of factors, including the introduction of import tariffs between the United States and China, weaker performances by Eurozone countries, and rising interest rates that are pressuring some emerging markets with capital outflows such as South Africa, some Latin American countries, as well as Asia. Gary White is chief investment commentator at Charles Stanley.
It will crimp global growth. However, this year we're sort of going to see above trend global growth. Next year, we have a dampening. If even in a full-blown trade war, the IMF see just 0.8% of global GDP growth. And when it's around 3%, we're not too concerned about any recession coming from the actions of Donald Trump with China. Although hopefully we can have some sort of resolution, which will be a great positive for global markets.
The IMF said in an update to its World Economic Outlook that it is now predicting 3.7% global growth in both 2018 and 2019, down from its July forecast of 3.9% growth for both years.